Right, we have a good question here from Abu, who asks us about the short-term catalyst driving asset prices in the short term. Whenever there's no clear catalyst driving assets, what do they follow? Do they follow their medium or longer term fundamental bias, or do they just simply follow price action? Now, thanks for the question, Abu. And the quick answer to the question is that assets usually follow the path of least resistance, which whatever that may be. And what that means is that mostly we know the shorter term movements in price will be dictated by the current sentiment of the asset. And of course, in the medium term, it should be dictated by the overall macro fundamental bias for the asset. Now, when there are no short term catalysts that drive price in a specific area, the price should follow the path of least resistance. And that means that it can either fall back in line with its macro fundamental bias, or it might be trading in line with other common correlations. Or at other times, it might just be trading off of key technical levels. And unfortunately, there's no clear way in knowing which part the market will choose to focus on at any given time. Now, even though we won't always know what the price will choose to follow, we can, of course, make sure that from our end, our knowledge of that particular asset that we're trading is on par to know what type of other factors might be influencing the price. Now, when we look at something like the Aussie dollar, I think that's a good example. Apart from the RBA and central bank policy, there's many other things that can influence the Aussie dollar. The Aussie is very sensitive to China news due to to China being its biggest trade partner. So any massively positive or negative news and data coming out of China can be a driver for the Aussie dollar. It's also very sensitive to commodity prices. So any sudden flows in commodities, especially things like iron ore and coal, which is the biggest exports, that can also be a factor to drive the Aussie dollar. At other times, it might be risk sentiment with things like equities. At other times, it might be the US dollar. Other times, it might be big mergers and acquisitions. And if there's absolutely nothing happening of any type of significance with any of those common factors, then the price might just be dictated by random ebbs and flows in the markets, which does happen. Now, what that means for us in trading is basically twofold. We only really need to be concerned about this from an intraday perspective. So from a short-term and intraday perspective, it means that we should rather stay away from something when the market doesn't really have a specific reason to be either buying or selling it in that short term. When it comes to swing trading, we can take a more relaxed approach to this, because those types of days when there's seemingly nothing noteworthy moving price, then we can, with some degree of confidence, expect the market to fall back in line with that overall fundamental trend that we are hopefully trading in line with when we take a swing trading position. So we can be less concerned about that from a swing trading point of view. It's more of a concern when we talk about intraday moves, where we really want the market to have a reason to be buying or selling something. Now, a good example of why, from a swing trading position, we shouldn't really be too concerned about it. A good example of that for me was equities this year during the month of July and August. And if we take a look at the S&P 500 chart, of course, we had a nice strong move to the upside during those two summer months. And what normally happens during the summer months is we have expectations of thinner liquidity and lower volumes. And that is exactly what we got this year around as well. And because the overall bias during that time for equities was strongly tilted higher, it didn't really take a lot of catalysts to continue pushing equity markets or equity prices higher. Now, of course, there was some days when we had some short-term catalysts that moved the price higher, but for the majority of July and August, equities basically just kept on steadily rallying to the upside without any real short-term positive catalyst in play. And it wasn't because because the bias was tilted to the upside. There was simply a lack of negative news that caused the markets to simply follow that path of least resistance, which was to the upside for equity. So, this is a good example of when it comes to short-term trading, we want a reason, but when it comes to swing trading, the market doesn't always need a reason. It might just always follow that path of least resistance, whether that is whatever type of factor it wants to focus on. It should normally just follow that overall path of least resistance. So I wish there was more concrete answers that I can give you, Abu, about what to look for. But as with many things in trading, the answer isn't just one thing. It's usually a combination of a couple of variables and factors that we need to keep in mind at any given time. But a good rule to trade by in your trade plan, if you're more structured towards day trading is having the discipline to stick to your plan by only buying or selling any asset when you think the market has a real good reason to be doing so. And not only obviously from a short-term perspective, also from a swing trading perspective. You also always want to be aligned with where you think the market will be trading that particular thing. And because that is normally the path of least resistance for any type of asset in the market. So I hope that helps with the question, Abu. Any other questions, as usual, please don't hesitate to let us know.